So just put out a blog post on private credit and some thoughts there. It's getting a lot of traction in terms of, I guess, attention in the market. Private credit was something that's been around for a long time, but there were some things recently that put it more into the public. I think the biggest one was about 6 months ago. There were some regulation changes that allowed private credit and other alternatives to be added to retirement plans. And with retirement plans being one of the main wealth accumulators in this country that most people participate in, I think that really got a lot of people's attention and thinking about it in a way they've never thought about it before. Chris, you and I have had conversations offline about that, but was it a year ago or 2 years ago that you started kind of looking at it and scratching your head, wondering when, some disruption there was going to happen? Talk a little bit about what you were looking at, what disturbed you about it, and kind of what your thoughts are on it today.
So I think it's probably helpful to know what is private credit. It's basically lending that takes place like outside of what a normal bank or normal bond market would be. So that means that like maybe a company that is not publicly traded or has never gone through the process to get a credit rating or something so that they can go issue bonds, or maybe they're not big enough to issue large bonds, but they still want to borrow money. And or maybe it's something that a traditional bank won't lend to. And so there's no doubt there's like companies and organizations that exist in this in between. And so they want to go borrow. So private credit came up as kind of this option of companies that said, well, we'll provide the lending to them. We'll get access to credit maybe at a lower cost somewhere else, and then we'll lend it to them at a higher interest rate. One of the most popular pitches is it's like equity-like returns with bond-like risk. And I went to a conference put on by multiple major investment firms in the US, and they could have picked any topic. They were there to kind of get chief investment officers to invest in their products. And so they could be selling anything. And some companies were selling totally different products, but I think probably 80% of the firms that were there were all selling they were all selling private credit to RIAs. And it was really interesting because basically every single company had the exact same pitch. They all said, we have found mid-market companies with investment grade like bond ratings, even though they don't have bond ratings. And we have found ways to lend to them to create equity-like returns with bond-like risk. The first time I heard it, it sounds super interesting and attractive. And then I heard it again with another firm, and then another, and then another. And once I started realizing that every one of these major companies is talking about the exact same thing, it started to raise like some red flags to me, where it was like, hey, what's really going on here? Is there really that big of this market of totally unmet need that all of these companies could be saying and doing the same exact thing? But I think what's happened over time is so much money has gone into private credit because there is like a genuine demand there and a genuine need, which is creating genuine value. And that's all legitimate. But there's been so much money that's rushed into it that it may have put some pressure on some lenders to give loans in cases that are not going to be as attractive in the long run.
Yeah. And I think one of the other things that stood out to me that was a little bit, alarming, and I mentioned this in my blog post, is, these firms are grading their own homework, right? So you have a firm that issues or purchases the private credit, issues the private credit, and then their insuring arm then buys the private credit and marks it. And so it's kind of like, the same folks that are being graded on it are grading the value and the credit worthiness of it. And of course, they have an incentive to make sure that those grades come out strong as a self-fulfilling prophecy. And obviously, if they're not, there's a consumer protection concern there. Any thoughts on that?
Yeah, here's an example of something pretty interesting I saw. I saw a chart that was showing the creation of what they called other loans and leases by banks in the United States, by all U.S. commercial banks. So it showed how much new credit was created. And from like 2021 to 2024, most of the new credit was banks giving loans for real estate and regular commercial loans or industrial loans. These are things that historically we always see are like the main drivers or creators of credit. But from 2024 and through 2025, it's not even close. The new loans were all basically private credit and private equity. That's where all the loans that the commercial banks were creating was going to private credit and lenders and private equity. And so when you look at it, like 2024 and 2025, it's something like 75 or 80% of the new credit that was created in those 2 years from commercial banks was to those other loans and leases is what it's titled, which is usually like private credit, private equity being two of the largest recipients. So there's no doubt there's real need there, but the balloon and the growth was so rapid and so fast in these 2 years. And then, like you said, the companies themselves get to mark what is this loan marked at. And so we're already seeing there are some publicly traded private equity companies, and their stock prices have really been getting hit pretty hard over the last year. What's interesting is the prices are getting hit hard, even though kind of the marked value that they're being reported doesn't look as bad. And so there's a little bit of a disconnect right now. People are wondering, well, why is the price down so much if they're saying that the losses aren't as big as, why is that that disconnect? And it's exactly what you're saying. Nobody really knows. Can you 100% trust that, or is there any self-interest in how those are priced? So the problem is now if it goes into a 401k, then what are the odds that a typical employee at a typical firm is going to be able to go and look into that and understand exactly what they're getting? Because that initial line of equity returns with bond-like risk is a really attractive line. I found myself as somebody who's like, I feel like I'm pretty informed on investments. And I found myself hearing that and thinking, boy, that sounds like what an awesome thing. And I think there is probably a really good spot and there's good companies and it is a real need, but there's probably been too rapid of growth.
Yeah. And as far as the 401ks go, who then becomes responsible? So retirement plans are more complicated because there's a lot of entities overseeing that. The Department of Labor, ERISA, the SEC. As an employer or a plan sponsor, you're a fiduciary on that. You have a responsibility there. As advisors who work with retirement plans, we have a responsibility. And so then the question becomes, who's responsible for making sure that the investment lineup, which would in this case include private credit, who's there to ensure that that's going to have the desired outcome? Because now we're talking about people's retirement accounts, what they're planning on living on in retirement. That's scary. And so, yeah, I think that it sounds really good, but kind of caveat emptor, right? Buyer beware there. And I would really pump the brakes if you're an individual in those retirement accounts. Certainly if I'm a fiduciary on that, we haven't added that to any of our retirement plans just because to me the risk is greater than the potential reward because we just don't know. And one other thing to piggyback on to why I think we're seeing a disconnect between the value of these funds and what they say they're worth, meaning, we've seen the price of these publicly traded funds go down, is you've got this concept that's starting to emerge, which again, if we're talking about someone who's just investing in their 401k, who doesn't spend a lot of time really digging into this, there's these things called payment in kind. And so as companies, the ones that are actually utilizing this private credit are required to pay this money back, if they're having cash flow issues or revenue issues and they can't do that, one tool that these companies are using, meaning the private credit companies, the ones who are lending the money, is this payment in kind, where if you owe interest on that loan and you can't pay it, they're going to tack it on to the loan. And so the loan is still going to look healthy because the interest has been paid functionally. However, it's like taking one credit card and paying it off with another. You're not actually reducing the loan balance or the outstanding balance due. In fact, you're increasing what's due by tacking on interest to the outstanding loan. And so it looks like the interest has been paid. It looks like the payment has been made. But in fact, if you look a little closer, that interest has just been added to the corpus of the loan. And so we can check it off that it's still healthy and still as agreed, but it's not actually reducing the risk by reducing the outstanding balance. And I think that is another big concern as we really look under the hood of these things to examine the true health.
And it's interesting to see what happens because right now there's like the huge majority of all private credit growth, like of credit growth in the US over the last 2 years was literally in this area. But what a lot of people may not understand in their retirement plans is typically these private credit funds, you can't just put your money in and then take your money out when you want to. They have lockup periods. And so then if you want to take money out, you maybe have to wait till like the end of a quarter or something like that. And then you have to request. And what they do is if there's a lot of people that request, then they don't give everybody back what they want because they might have a limit that only 3% or 5% of the total portfolio can even come out. Well, the reason this is interesting is some of the largest private credit firms, and it's not like calling anybody out. It's just who, it's just some of the largest private credit lenders. They've actually gated the withdrawals, meaning that they've said we're either pausing all withdrawals or we're limiting how much there can be. And so some of these funds had as much as like 30% of the investments were requesting to get out. And the firm said, well, we can only give 5% or we're just saying zero right now. And to their credit, they're saying, well, people might be overreacting some right now, and that's why they're making the withdrawal requests. And we're doing this because we need to protect the fund, and it's not actually as bad a shape. And that could be correct. But the risk there for someone in their retirement plan is if they don't understand how this works, and if they just think of it as maybe a traditional ETF or something that they have, that it's just kind of like, oh, I buy it, I can sell it, I can just move the money when I want. There's other considerations with these. And so we really have to hope and trust that employers are providing that education for what it is, but that may not be the case everywhere. And so it's just something to be really aware of and maybe have someone that can give you good recommendation or advice, like should it play a role? How big of a role should it play? And it's not like with a normal ETF where you just say, oh, it's the S&P 500. I put money in and it's kind of the same as all the other S&P 500s. We're probably going to find that some private credit funds will be fine and some are not. And it's going to be really different. And so unless you have the ability to kind of dive in and understand that, then it might not just be the same as any other investment in a retirement plan.
Yeah. I mean, the manager is the investment, right? There's going to be some that do well. There's going to be some that don't. And I think it's going to come down to who that manager is, how they are assessing the risk, and what guardrails are they putting on their private credit. Is it going to be highly concentrated? Is it going to be more diversified? One thing interesting, according to Morgan Stanley, over 50% of the funding for data centers and the data center build outs over the next year and a half to 2 years is going to come from private credit. So we know that that's a real infrastructure and movement forward. And then we're coupling it with this private credit concern. So that'll be very interesting. So speaking of data centers, let's flip over to SpaceX and their recent IPO. Any initial thoughts there? And I say data centers because one of Elon Musk's stated outcomes for going public is to get the cash necessary to go to space to build data centers. And so thoughts on the SpaceX IPO, at least in the first month or so that it's been public now?
Well, what I will say is when I hear the story about SpaceX and Tesla and what they're going to do, and I hear the abilities of what people are talking about with like mining on the moon, manufacturing on the moon, and then just sending completed products back to Earth, that stuff is crazy exciting. And it's crazy that this is real life and that like it's within reach that we can do this kind of stuff. So when I hear those things, it's like, man, this is incredible. And probably 10 years from now, 20 years from now, we might all be talking about SpaceX and how we all just use their services in some way. The same as like so many people talk about Amazon now, that 20 years ago, not everybody thought they would just talk about it that way. So my guess is that's probably where we end up if even part of what they're talking about comes through. I think the challenge right now is that is really cool and really exciting, but are you willing to wait the whole 20 years? And what we find is a lot of people that invest aren't. They're not willing, like they want to buy it now and they want the whole story to be true now and they want the profit to show up now. And it's not always the case that people are willing to see the vision and wait through all the churn that might come. So I think that's what we saw is like SpaceX went public. The price was super high. Its price to revenue was a really high number. And I think the price peaked around $200 a share. And the last I saw was like, it even hit 145 or something like that. But let's see I think we're back down now to, I was trying to pull it up right now. We're at 138 right now. So it's getting really close back to the original IPO price.
And to your point, they did about a little under 19 billion in revenue. And at the peak price, that was 150 times revenue. So a huge number. And just to put that in perspective, when it got up there, it briefly surpassed Amazon in market capitalization. But you look at other organizations that are in that range. Meta did 200 billion in sales last year. Tesla did 95 billion in sales. So there was obviously a lot of hype around it, a lot of pent up demand, which is why I think we saw the run up. I do personally think that in the long run, this is exciting stuff that will probably work out in some way. I think Elon has proven over and over again, don't bet against him, not investment advice, but don't bet against him. And I would tend to agree there. But we're all over the place. If you look at analysts, you've got ranging anywhere from a price target of $62 up to $800. So no one really knows what they think. And I don't think anyone's convicted. And certainly as an industry, we're not convicted on where this is going, at least in the short term. I think in the long term, they will have to continue to increase revenue. And keep in mind, SpaceX isn't just about data centers on the moon, right? That's a stated end case, but it's the rockets, it's Starlink, it's a lot of different things that are generating revenue. But we'll need to see that revenue continue to increase to justify the long-term growth of the stock.
Yeah, and like Amazon, at one point in the dot-com crash, Amazon's stock actually went down 80%. And so, you go back 20 years or 26 years, and you think the stock price went down 80%. They had this IPO, the price went below it. And I guess it would be easy for people to say things like, well, this isn't what we thought it was, or the company's not growing fast enough or whatever. And so I just wonder if some of that will be the case now, that maybe everybody's excited by it and we may get a drop in the price. And so, short term, it's something to be wary of, and whether somebody really has the confidence to just hold on to it. But it is interesting, though, especially when you hear people talk about Elon Musk's net worth, hitting $1 trillion. I'm looking at a list right now. Projected 2026, there are 21 countries in the world with a GDP expected to be $1 trillion or more. I'm going to read just a few of the countries below $1 trillion. These are the highest ones that would be below $1 trillion. There's Ireland, Belgium, Sweden, Israel, Argentina, Austria, Colombia, Vietnam. These are all countries whose GDP would be lower than Elon Musk's net worth if he was at $1 trillion. So I'd say this is a pretty incredible thing to take place in the world.
Yeah, that's wild. And so Elon actually owns 4.76 billion shares. So for every dollar move in the share price, his net worth changes by $4.76 billion. So you said they were down to about $138 as of our recording today from $145. So, that's $7 changed times 4.76. So, he's down over $30 billion this morning. So the numbers are mind-boggling as far as that goes. But, what's really interesting is, so his comp milestone, 2 milestones specifically that I thought were fascinating. One is a $7.5 trillion market cap. And so we IPO'd at a $2 trillion market cap. So there's confidence there, at least from Elon and his board, that they will 4X from their market cap. But another milestone for his compensation is 1 million people on Mars. So, bash him all you want, but it's not like his comp package is easy to attain. The guy has, and again, he's done things in the past that are pretty incredible compared to what people thought. But yeah, I want to go back. You said Amazon dropped by more than 80. It actually dropped over 90%. And I want to put this into context. And specifically, it says 95 to 96%. So I did a quick search on that. So from its peak after the IPO during the dot-com crash, like you said, but if you had bought it at its IPO and held on to it until today, it's still up on a split adjusted basis over 327,000%. So, and we had a lot of clients asking us about SpaceX and buying it and worrying about missing the run up, and what if it gets to $500 or $600 a share and trying to cash out, and obviously that didn't happen I think it was priced almost perfectly at $150 a share, just based on where it landed back. But the long term, if you believe in the viability of the S&P 500, if you believe in the viability of these individual stocks, that's really what creates growth in the market. And we've talked about that before, right? It's not gambling. It's not a casino. What causes growth with the S&P 500? Why has it increased on average, pick a number, 8, 10%, whatever that number is, however you do those, however you measure that. But why has it increased in a meaningful way on average over 100 years? And the reason is we measure the market based on the underlying stocks, which are actual companies, and what economic value they add to our country. And so if you think about SpaceX in that same vein, the real question is, and it kind of goes back to where you started, was, if you're willing to hold on to this thing for 20 years, what you have to ask yourself in order to make that determination is, do I believe that over the next time frame, 20 years, 10 years, 5 years, do I believe that SpaceX is going to add more economic value to the economy, to the country, than it is today, right? And that goes back to that revenue number. That goes back to some of those compensation milestones. And if you believe that, then it's a great time to buy it at a dip at 138. And maybe even if it goes down farther, or even if it goes up a little bit, because the growth of that stock over a long period of time should be meaningful if we believe that it's going to continue to add value.
I think the challenge for most people is they say right now, I'm good to just wait, but it's, I think it would have been hard for a lot of people if they put any significant amount of money in Amazon and then you watch it go down 90%. At a certain point, that reality comes back. And so that's the challenge.
Yeah, but it's really, and that's what, removing the emotion and decoupling the price from what you believe the value to be. And right, that's really where all the fundamental analysis comes in, is it's this forward-looking earnings. There's not any analysis done that's looking backwards to evaluate a stock or an index to determine whether we think that that's going to go up in the future. All of the analysis is forward-looking, like how much revenue is going to be generated, how much value is going to be generated. Every fundamental analysis that you can do on a stock or on an index is from that lens.
I will just say, this is unrelated to SpaceX, but my father-in-law, he has this Tesla we got because he was uncomfortable driving at night. It is full self-drive. I've used it multiple times. It is unbelievable to me. Like, it truly is unbelievable. And anytime I ride in it or use it and I see what it's capable of doing, then in my brain, I'm just like, holy cow, if there's really going to be these Optimus robots that can have this type of level of intelligence, and like, we've been driving on a road and there's like a person riding a bike in a place they shouldn't, or some random thing that comes in, and I was so skeptical, like, how will it respond? And it's so good. But so then I just think you get a glimpse of what's going to happen with these humanoid robots, like if they really can get it to take in this whole environment and perform tasks and things. So that kind of stuff is pretty cool. So it gets me excited when I hear that we're going to mine asteroids, we're going to mine the moon, and where there's autonomous stuff. And I think that probably seems really far-fetched for people, but once you see this technology that exists right now, that I think even 5 years ago was hard to really believe or wrap your head around, it gets much easier to see what's coming. And so all of that, like, the stock market right now is pretty highly valued. There's, you can argue maybe it's overheated and those kinds of things, but long term, man, the stuff that's coming just seems really exciting. And long term, you're going to have to own a piece of those. And clients, I mean, people want to build wealth. They're going to have to own a piece, because that's how you benefit from it as well.
Absolutely.